With everything that's been going on these past few weeks, months, years, you might be asking, am I too late to profit from gold? Well, let's be honest, if you're already asking this, then you're already behind the people who don't need to ask. But the good news, you're not too late. Not by a long shot. You're right on time. In fact, you're ahead of everyone who doesn't yet understand what I'm about to tell you. We're living through a moment where gold has broken through $3,000 an ounce. It's made headlines, it's made jaws drop, it's made a few smug people feel very clever. But let's be clear, that number isn't a finish line. It's a flare, a signal, an announcement that something much bigger is happening underneath the surface. Because when gold is surging, it doesn't mean that the economy is booming. It means the opposite. It means things are breaking or have already broken. Gold isn't an asset that explodes because we've just discovered the next iPhone. It rises when trust falls, when systems wobble, when people start asking whether the people in charge are really, truly in charge. So if you're sitting on the sidelines wondering if the ship has sailed, well, here's the simple truth. The ship hasn't even finished boarding. Let's talk about this $3,000 number, because the thing that most people get wrong is that this isn't really about gold going up. It's about money going down. When you say that gold is at or above $3,000, what you're really saying is that right now it takes $3,000 to buy what used to cost you far less. Gold hasn't changed. It hasn't reinvented itself. It hasn't been repackaged. It's still the same lump of metal. What's changed is the purchasing power of your currency. And that change isn't an accident. It's by design. Yes, it's big. It looks clean. It feels historic and is in a way. But the speed of the move is what's more telling. Gold jumped from 2,500 to 3,000 in just 210 days. It normally takes years, plural, for gold to move that far. The last $500 jump took over 1,700 days on average. So this isn't just a rally. This is a rupture. This isn't the first time that gold's broken through a milestone. In 2008, it crossed $1,000 during the financial crisis. In 2020, it surged past 2,000 during the COVID panic. Each time it wasn't a celebration. It was a symptom. It was a warning light flashing on the global dashboard. And each time the underlying problems, they weren't fixed. They were papered over, kicked down the road, or monetized into oblivion, which is why we are here again. And the price action alone should be enough to make people stop and to think. This isn't being driven by Reddit threads or meme momentum. This isn't AI juice. This is gold doing what gold does when the world turns weird. Now, a lot of people hear $3,000 and think, well, I've missed it. But that's like refusing to get on the motorway just because the traffic's moving. It's still going your way, and it's not like the destination has changed. If anything, the need to get there is more urgent than ever. So what's even got gold here in the first place? Let's start with the dollar. JP Morgan reckons that the dollar is 10 to 15% overvalued compared to its long-term average. Now, currencies don't fall out of the sky in a single day, but over time things revert, and the slow, grinding dollar decline is music to gold's ears. The more expensive it is to hold paper, the more appealing it is to hold something that doesn't burn, inflate, or get sanctioned. And then there's the whole matter of real yields. The idea that holding gold is somehow unwise because it doesn't pay interest is one of the most pervasive half-truths in financial history. What matters is the real return on other assets. When inflation is 4% and interest rates are 3.5%, that bond yield isn't making you money, it's just losing it slowly. For years, gold has had an inverse relationship with real yields. But in the last couple of years, something changed. The Fed hiked rates at record speed. Real yields spiked. And yet, gold didn't blink. In fact, in 2023, it rose 13%. And that tells you something. The old rule still applies. Gold does well when real yields fall. But when they rise, gold is proving resilient, which means the downside risk is limited. And the upside? Well, we're living in it. Every currency in history has failed eventually, not from bad luck, but from overreach. Governments, they just can't help themselves. They spend too much, they borrow too much, and they promise too much, and then they print and print and print. And the US dollar might be the last to fall, but that doesn't mean that it won't crack. Gold has survived all of them. Every time a currency has failed, it's the asset that is still standing. It's not backed by promises. It doesn't need a central bank. It doesn't rely on consumer confidence surveys to maintain its purchasing power. That's what gives it a lasting appeal. So who's even buying gold now? Well, everyone you'd expect to know better are the ones buying gold right now. Let's not pretend that gold has suddenly become the cool kid at the monetary lunch table. But when central banks, sovereign wealth funds, and now even insurance companies and China start buying in bulk, well, you know that something's up. Central banks have bought over 1,000 tons of gold annually for the last 3 years. Think about that. These are not meme chasing, FOMO driven weekend investors. These are the institutions whose job is literally not to panic. They're buying gold not for the next quarter, but for the next decade. And look who's been leading the charge. Well, it's China, it's Russia, it's Turkey, it's countries that see gold not just as a strategic reserve asset, but as a strategic weapon, as a way to break free from dollar dominance, as a way to hold value that can't be frozen, seized, or sanctioned. Gold is becoming the reserve asset for this new era of distrust. And don't underestimate the return of retail. ETF flows after 3 years of outflows are back in. Physically backed, apparently ETFs are seeing fresh demand. And in the US, proposed tax changes could make it easier for those mutual funds to allocate to gold. In China, insurance firms are being allowed to buy it. That's not a bubble. That's a broadening of the base. If this were a concert, the band's still tuning up. The crowd is still arriving. The main act hasn't even started. So let's revisit that tired old phrase, gold has no yield. Yeah, and that cash under your mattress doesn't yield either, but you still keep some there, don't you? Not for growth, not for safety, but for independence, for control. And here's the thing, gold doesn't yield because it doesn't have to. It doesn't owe you interest. It doesn't need you to lure in with 5% teaser rates. It simply is. It sits there doing nothing while the world gets progressively more unhinged. And at the end of it all, it still buys you something real. But if you really must have a return, you can create your own and enter dollar cost averaging. It's old school, could be boring, but it works because you just buy the same amount of gold each month. Do not overthink it. When the price dips, you get more ounces. When it rises, your stash is worth more. Over time, not only will your average cost level out, but your stress levels are going to go down because your wealth is becoming something tangible. This is not just a technique. It's a real mindset because it removes the drama, the questioning. You stop trying to guess that perfect moment because that perfect moment, as we're seeing, just doesn't exist. It means that your gold purchases are now a habit. It's just like brushing your teeth. And there may be one day, whether you're retired or maybe you're redundant, or you just want to just do something a bit different, you can reverse that flow. Just sell the fixed amount each month. Congratulations. You have created your own income stream out of gold. You don't need to go beg a fund manager. You don't need to pay a redemption fee. You don't need to worry about whether interest rates have been cut to zero again. You've just got your gold. It is not a bet. It's a ballast. There are moments in market history when everything just seems to work. Stocks go up, bonds go up, even crypto has a go. But those moments pass quickly. And then what? Well, gold just isn't dramatic. It's just dependable. And that's the point. You don't hold gold to chase returns. You hold gold so you hold other assets that don't drag your entire future into a ditch when the music stops. JP Morgan calls gold one of the best performing assets of 2024. And not because of how it's performed price-wise, but because it did its job quietly, reliable, without fuss. And sometimes that's all you need. Could gold pull back? Well, of course. Nothing moves up in a straight line. But what exactly would bring it down right now? Trust in governments? Well, that's trending the wrong way. Real yields rising? Maybe, but gold barely blinked when they hit multi-decade highs. A strong dollar, overvalued by 15%, looking tired. The idea that gold is toppy assumes that the problems that drove it up have disappeared. They haven't. If anything, they've multiplied. Gold isn't for the end of the world. It's for the world that we're living in right now. There's this tired old trope that if you hold gold, you must be some kind of tinfoil hatted prepper who spends weekends burying coins in the garden. Nonsense. Most gold investors don't want to collapse. They don't want dependency. They're not preparing for doomsday. They're preparing for Tuesday, the day that the markets might throw a tantrum, the day that a bank quietly limits withdrawals, the day that yet another government casually adds 500 billion to the deficit. The FT recently called gold the real Trump put. That's telling because once upon a time, we expected policymakers to rescue markets. Now it's the metal doing the rescuing. Not with stimulus, not with spin, just with substance. Napoleon once said that when China wakes, the world will tremble. And he could have said the same thing about gold. Every time the world loses confidence in its leaders, in its money, in its promises, gold wakes up and it doesn't go quietly. So here's what I want you to remember. Every time you see the price of gold hit a new high, you're not watching gold get more expensive. You're watching money lose its grip. You're watching central banks quietly tell you that the currency you work for, save in, and price your life around is getting weaker. That's not gold rising. That is your cash melting. As Ralph Waldo Emerson put it, the desire of gold is not for gold. It is the means of freedom and benefit. And in 2025, freedom is getting very expensive. You don't get to choose your currency. You don't get to pick your inflation rate. You didn't ask for 0 interest rates, and you didn't sign up for 7% mortgages either. But you can choose what you hold. You can choose how you prepare, and you can decide whether your money is tethered to a financial system that looks increasingly like it's held together with duct tape and wishful thinking. Gold will not make you rich overnight, but it might stop you from becoming poor over time. It won't yield like a bond, but it also won't default or devalue or get debanked. You will not impress your friends at dinner parties, but it might just help you keep your dignity when the next crisis arrives. So no, you're not too late to profit from gold. You might actually be one of the lucky ones because you are one of the ones that is waking up just in time. So what do you think? Let us know in the comments below, hit subscribe, and let's keep the conversation going.